Hello, and welcome to episode 12 of the Ask About Wealth podcast. For regular listeners, you know, last week we dealt with an issue which I referred to as dealing with probably the largest asset any of us have in our lifetimes, and that's our home. And today I want to deal with the second largest asset most of us have in our lives, or sometimes the largest, and that's our retirement fund. But I particularly want to deal with it in the relation to death, the grim reaper. And one of the things I would say to you, and I find this in the consults I do, while Irish people are very good at celebrating death once it's happened, you know, the wakes and the parties and the month minds and all that stuff, what we're not good at, in my experience, is planning it in advance. We don't want to talk about it. We don't talk about it. The way human beings in general deal with death is we kick that can way down the road. So we all know it's going to visit us at some stage, but we all believe it's going to visit us in 30 to 40 years' time. That's how we deal with it. Just share with you, my father is 94 years of age, and I was asking him the other day, what's the difference between being 94 and being 84 or 74? And he said, I can no longer kick death can down the road. Death is imminent when you're 94. And that's the big difference on his psyche, he tells me, between being 74 when you can still say, well, it won't happen to me for 20 odd years. But at 94, you can't. The other thing we want to say is that, as we said, death is inevitable. And it's not without tax. It's not without cost. And there are substantial costs in when one person dies and assets move to the next generation. And as I said a moment ago, pension assets tend to be the second biggest asset in most people's wills. So today we've invited back a guest we've had here before, Aidan McLoughlin. Aidan is CEO of ITC. Is that correct, Aidan?
Yeah.
He is also the author of Pensions, Revenue Law and Practice, which is the Institute of Tax's volume on the rules and regulations of pensions. And I suppose, therefore, the oracle on this subject. Aidan, thanks for coming back to us.
Thanks, Paul.
Let's dive straight into it, Aidan. Are all pensions, from a death perspective, are all pensions the same?
The simple answer to that is no. I mean, in our business, we act as trustees of pension schemes from one-man bands up to master trusts. We have about 25,000 people whose pension benefits we are responsible for. And across those, there's a variety of ways in which they're structured and they can get pension benefits and who might receive those benefits if in the event of the death of the member of the scheme. So there's a lot of technical rules and a lot of different treatment, both in terms of what type of pension product you're involved in, what are the rules governing that, what are your own circumstances, because how pension benefits are treated, both in terms of who is in the pool of people that can participate in the benefits when they issued and how they're treated for tax purposes, can vary according to the age of the beneficiaries, their relationship to the deceased, the employment status of the deceased, the income of the deceased. All of these are variables that play into how much of a benefit is available and to whom it might be available. So there's a huge need for people to understand that it is, in many cases, an extremely valuable benefit, as you say, and in some instances, greater even than the family home asset that people will accumulate. And it needs to be properly managed, or it may not be maximised. The benefit, it may not be maximised either because it's not flowing to the people who need it the most, or because due to the structure of it, it's paying more tax than needs to be paid in relation to a benefit of that nature.
Okay. You're making me rethink something I've often said in the past, which is the easiest way of getting money out of a pension fund is to drop dead. It doesn't sound like that's necessarily the case. In terms of the different types. So I would estimate, Aidan, that the vast majority of our subscribers and listeners fall into one of two pension categories. They're either self-employed with their own limited company and have a pension scheme that the company is sponsoring in some shape or form, or they're employed by the big multinationals, and they would be members of a group scheme. Can you tell me how those two schemes might differ in terms of what happens if somebody dies before they get to the gold, before they get to being able to take the benefits in retirement?
So the first thing, if you take the person in a multinational, for example, what they may not realise is there's actually two death benefits that may apply to them in their employment. The first is the actual pension fund they're accumulating for their own retirement, and it obviously starts small and grows over time. So depending on the age at which they might die, that can be either a very small benefit or kind of accumulated to quite a significant amount. But entirely independently of that, there may also be a benefit that is a life cover benefit, typically based on a multiple of salary. 2 times, 4 times, 8 times, I've seen 10, 12 times salary. That's a benefit. And obviously, if this is triggered, in your first month of employment, that second fund is going to be of enormous significance compared to the amount of savings you've actually got in your pension scheme. In some cases, those schemes are documented separately, so they don't even have the same set of rules. And that's become much more common in the recent past because many pension funds have moved from being standalone schemes to master trusts. And many of the master trusts didn't take risk benefits in, they don't allow them in. So that forces the risk benefit to be separately documented.
So what, if I can read between the lines, what you're saying is that the treatment, somebody saves in their pension fund and unfortunately drops dead. They have a certain amount saved in the saving element of that pension fund, which is now due to be paid out. And they have a certain amount of life insurance, I suppose we can say, which is the death and service benefit, the 2 times, 4 times, 8 times salary. And those two benefits are treated differently for succession purposes, for tax purposes. Is that what you're saying?
The statutory rules, the revenue rules treat them the same, but the documentation of them is different, and therefore there may be different wording as to how they're applied. So when you're coming to a death benefit, you start with, well, what does the Pensions Act say? Because it overrides everything. It doesn't matter what the deed says or what revenue think if the Pensions Act has a rule in it. Then you look at revenue rules. Again, it doesn't matter what your deed say. It can't override the revenue rules. And then you look at the specific scheme rules. So when you get down to the specific scheme rules, for example, the definition of the potential beneficiaries may be wider under one document than the other. When you look at the circumstances of the family, you can find, for example, that under this deed, there are 7 people that I can consider provide a benefit to under this deed. But under this deed, there's only 4 because there's a tighter definition of beneficiaries. So, for example, one of them might include all children, while the others will only include children up to the age of 21. And therefore, as each child reaches the age of 21, they will go out of the list of potential dependents. Now consider it from the point of view of the deceased. They may have thought of it as a single benefit because it might be presented that to them, not realising they have to do, for example, 2 letters of wishes. 2 separate trustee bodies have to make decisions on this. So, and they be cognizant of the way the rules of each work as to how they decide to do it. So if one deed excludes the adult children, then you may want to vary the benefits coming under the other deed to compensate for that and make sure that everybody's looked after adequately according to your wishes.
So, I mean, you mentioned this before we started recording, this letter of wishes. I mean, I certainly wasn't aware that it is prudent from what you're saying that anybody who's a member of any pension scheme where there should have a letter of wishes written to the administrators and trustees of that scheme telling them what they want to happen in the event that the wheels fall off, in the event that they don't get to the golden age and ultimately retire.
That's correct. And in many circumstances on a death benefit, the trustees of the scheme will have discretion as to how the benefits are to be applied. And the way that discretionary clause works, it will define a potential list of beneficiaries and just give the trustees the discretion to apply it to one or more of those individuals without giving them any further indication as to how you weigh the claims between the different individuals. What a letter of wishes do is not legally binding on the trustees. They can go their own way, but it gives them a signpost as to how the deceased saw the benefits being distributed, and also can act as a source of information as to who should be within the pool. Because we had an example where that arose, for example, where the family knew about, obviously, the spouse and 4 children. But unbeknownst to them, there was a further child the deceased had that he would have regarded as his financial dependent, because he'd been providing them with money for many years. They're now an adult. But they would be within the definition of dependence for the purposes of us as trustees considering who we might make a benefit payment to. It wasn't anything malicious on the part of the family, who would be the normal ones to take out the grant of probate, etc. They simply didn't know about the dependent to put them into the mix. But because we had a letter of wishes naming the dependent, we were able to identify that dependent. And again, because of our discretionary power as trustees, we could allocate a portion of the benefit for that individual, whilst also making a payment to the other beneficiaries that were in the known family of the deceased.
So when anybody's signing up to their company pension scheme, whether it's big tech company, big pharma company, I mean, it's not I was involved in delivering those schemes for many years in a past life. That was never a subject we brought up with the fella signing on the dotted line. Is that a subject that is brought up, or are we saying to our listeners, well, you have to bring this up? Because the fellow who's selling you the pension isn't necessarily going to do this.
Correct. You had correctly identified at the start, we're not great about thinking about death anyway. And secondly, at the point in time at which pension benefits are being discussed, everybody's focused on the rosy, optimistic outcome, which is that it's the beneficiary themselves, the employee themselves, will be the beneficiary of the planning. And there's a little bit of contingency planning there, but it's kind of like insurance on your house. How many people really get into the detail of that until something happens? Unfortunately, the same can occur with the risk benefit inherent in the pension structure, that people don't necessarily think about it. And it's left to the trustees to try and piece together who the dependents might be and what the wishes of the deceased might be.
And you said to me again before we started recording that the trustees aren't necessarily bound by the succession law of Ireland. They have some discretion here. Tell me a little bit about that.
So when the benefit is held in trust, the trust deed and the statutory provisions governing that trust will dictate how it passes on. But it doesn't fall within the estate of the deceased. It doesn't require a grant of probate to be administered. The trustees are in a position to pay immediately rather than waiting 6 months or a year for a grant to issue. And equally, the succession structures provided for under the Succession Act don't apply to that trust. The rules of the trust do. But, for example, there is a legal right share that a spouse might be entitled to. Children have a right to claim for proper provision. But the trust itself isn't necessarily bound by those. Now, in practice, many of the clauses will include a spouse, children and financial dependents within the definition, with certain variations to it. But it's not necessarily binding on the trustees. So we don't necessarily have to, for example, insist that somebody is married to an individual to pay a benefit to them if we can show they're financially dependent on the individual. And the circumstances of that can throw up interesting circumstances. One I saw in the UK, in fact, was where an individual who was a member of the army met a lady that he got on very well with, and within 3 or 4 weeks they moved in together. A week later he's called up for active service in Afghanistan and never comes back. Now, that lady wasn't a spouse, wasn't a long-term partner, etc. And the trustees had to decide whether that individual was capable of being included in the benefit pool or not. In the instance, in that case, the trustees felt not, because it was a relatively short-term relationship. But when the person took a case to the ombudsman, they said, no, I think there was enough financial dependence there. They had taken on a flat together. They were sharing their financial position together, and that was enough to bring them within the definition of a financial dependent, and therefore could be included in the pool of people. Now,
even though the succession law wouldn't have contemplated them as a beneficiary at all.
Correct. And that is one of the freedoms that the pension benefit structure has. So look at the advantages of it in that way. But it does require then a bit of consideration by everybody for this. So, for example, if you take that case, obviously the trustees have to know of the existence of that person. You know, it might be that they hadn't entered into a flat together, and therefore there wasn't a joint lease that you could see the name of the person on. When a death notice has been written up, would the family have put the name of that person on the death notice? You know, the way in Ireland there's a very clear order in which everybody relevant to the
RIP.ie.
Correct. And you know, for trustees, RIP.ie is a fantastic source of information. But it's not perfect, because, you know, had that individual even shared with his family the relationship he had with this lady? And I'm only using that as an example. It isn't even from this jurisdiction, but it obviously is something that occurred. Similar type cases occur all the time that we as trustees have to work through.
Yeah. I remember there was a phrase coined years ago, where there's a will, there's a relative. And I think, you know, I'm thinking here as you're talking, where there's a pension fund, there's a potential beneficiary, you know, in terms of, you know, there could be beneficiaries, as I said, that aren't considered such by other legislation, like the Succession Act, as an example.
We had a case just on that. We had an individual who died as a member of a pension scheme. Nobody in the employer company could identify anybody that was a life partner or girlfriend of the individual involved. There was no near family members. There was no spouse. There was no children. The parents were dead. There was no siblings. And we did have a gentleman that used to contact us with suggesting that he should be considered as a dependent. It used to happen later in the evening. It sounded like when he had some drink on him. But the basis of his claim was that he had bought drink for the mourners at the funeral, and that was his claim to it. We had to point out to him that actually didn't make him a financial dependent. He had to be in receipt of some financial benefit from the deceased. But it raises an interesting question. For example, if I send a £5 to my nephew, does that make him a financial dependent? If I've set up a mechanism that puts £1,000 a year aside for my godson and ensures that it pays for his education, well, he could be a financial dependent. So people can have financial dependence that aren't immediately obvious, apart from, you know, the near family, etc.
Right.
Where people have taken on moral obligations of whatever sort.
And you told me a story again before we were recording about the multiple wives story. Can you relate that to me again?
Well, we had as trustees, we had notified of a death on a particular scheme, and we contacted the employer company, and from them they said that the person was an individual with no children, but had a long-term partner. They weren't sure, but they felt that the individual wasn't married, but it was the person that had been at the Christmas party for the previous 4 or 5 years. So we were able to contact that individual and establish that they did indeed have a significant relationship. They lived together and therefore, regardless of the marriage, qualified as a financial dependent. And in the absence of any further information, we were moving towards where we could distribute the benefit when we suddenly got a letter from another lady, unbeknownst to us or anybody else, who pointed out that she was a spouse of the deceased and only just heard he had died, and produced a marriage cert to show that. They'd obviously been separated, but clearly as a legal spouse would have a certain, would come within the potential care of the deceased, and we had to evaluate that. They'd been separated for a number of years. So that created a little dilemma for us to discuss and try and evaluate how we would balance the competing needs there. When after another couple of weeks, another letter arrived from a third lady, also asserting to be a spouse and also producing a marriage cert, which in fact predated the second lady's marriage cert. So now we had doubts as to who was married or was anybody married. We had no evidence of a divorce. I would say the individual had lived in a number of jurisdictions, and the spouses or purported spouses also lived in a number of jurisdictions. So it was complicated to ascertain the facts. But based on the evidence that we had, our ultimate conclusion was there was 3 people there which, in our view, fell within the definition of dependence of the deceased in one way or another, whether it's legal or moral dependence, and we felt it was appropriate to share the benefit between them. That's an example of the discretion that's available to the trustees. We weren't bound by
the laws of succession.
The laws of succession or the need that we didn't have to decide the validity of the marriage certs.
Okay. I have one more question for you, and there's a bit of a personal angle to this. Because during our conversation a week or so ago, I was saying to you that I have 4 children. I have 2 children who are under the age of 21, and I have 2 children that are over the age of 21. The 2 over the age of 21 are no longer in full-time education. The 2 under are. And you were telling me that they would be treated differently if they were inheriting my pension fund tomorrow. Can you put some meat on the bones of that for me?
So the rules governing the potential beneficiaries of a death benefit under a pension scheme typically include a list of a description of the type of beneficiaries: a spouse, children, and financial dependents. Under the children clause, a child is regarded as a child up to the age of 18 or 21 if in full-time education. So quite clearly, just achieving the age of 18 has the potential to change your status. Consider a child that decides to take a gap year, see the world, and then come back to education. They were in the pot before they reached 18. They're now out of the pot, and they'll come back into the pot when they return from their gap year and go back into education. So the financial planning that you might have taken on board and done very carefully, recognizing that, is interrupted by a decision that your child will make that, with the best will in the world, you can only have a small influence on in modern life. But you have to be able to recognize that as to how it may happen and deal with the what ifs. Equally, when that person reaches 21, they may come out of the bracket of potential beneficiaries, even though they may still be financially dependent on you. They may be resident in your house and eating food that you paid for. So
still eating my food.
The rules of the scheme need to be considered and dealt with, and more modern schemes have tried to use a more liberal definition to include children within the financial dependence piece rather than just defining them under the children clause, because the regulations governing children are quite restrictive.
And there's a tax difference, isn't there, between, so if, let's make the maths very easy. I have 4 kids. They each can inherit 400 grand tax free. If I had a pension fund of 1.2 million quid and I left that to my 4 children, 2 of them would pay one type of tax and 2 of them would pay another type of tax. Isn't that correct?
There's a difference in the tax treatment of one of the types of pension structures we mentioned at the start, the type of pension structure you have can vary it. So when you get to a post-retirement structure, which is called an ARF, an approved retirement fund, the rules governing it distinguish between children under 21 and over 21. So if the beneficiary is a child under 21, they are exempt from income tax on it, but potentially liable to CAT.
Inheritance tax.
Inheritance tax, yes. If they're over 21, they're exempt from CAT, but liable to a flat rate, 30% income tax on it.
So if this was the only asset I had and my two under 21 children inherited 400 grand each from that type of pension fund, they would get that tax-free because that's within the tax-free threshold for inheritance. But my older children would pay full tax on their 400 grand because it was income tax, not inheritance tax.
Correct. And it's also the case that that's a flat rate income tax, which, because the 30% sounds good, but it means you don't get any of your allowances and anything on it.
And the rate is 30%.
It's a flat.
So
30%.
In that example, two kids get it for 400 grand each, zero tax, and the other two kids get 400 grand each, but pay, 120 grand in tax each.
That's correct. And that's at an instant in time. The circumstances are changing throughout. So your planning, well done 5 or 6 years ago, is being altered each year as your children age.
Okay. Look, I want to move away a little bit, if I may, and I know that it's your core subject of the pensions, but I want to talk about debt in a broader sense. I sometimes say to people, today's newspapers are filled with the names of people who didn't think they'd die yesterday. And that, I mentioned earlier about us, how we deal with that, kicking the can well down the road. If you have an opinion about, what is the absolute minimum planning that people should engage in where the threat of death is concerned?
It's well worthwhile for them to sit down and consider the prospect. As you say, Irish people don't. That's wrong. You just have to sit down and say, this is a prospect at any time, no matter what age you are, and to work out who your care is, who needs to be looked after in the event that something happens to you, and then review that on an ongoing basis. Within that, there are two mechanisms that you can use to help with distribution of assets. You can have a will, which deals with all your assets that don't pass under trust, and you can have a letter of wishes to the trustees of any pension benefit that you're involved in. And that may be multiple benefits, because in addition to what I mentioned earlier, the risk and the savings plan in your current employment, you may also have benefits in a trust for a previous employment. So that's not just one letter of wishes. Yeah. You may have a number. And the rules as to how they apply may vary because of legislation, but it's useful for the appliers or the trustees or others who have to apply rules in relation to that to at least know what your thinking was in relation to it.
And one of the things that I find problematic is probably not the word, but I'll use it, is that for the most part, solicitors, I told you a story earlier about a friend of mine years ago who lost his wife, unfortunately, to cancer. And about 6 years later, he met a new lady, and 2 years after that, he got married to the new lady. And we're having lunch one day, and he's telling me, I'm asking, how's it going? He says, great. And he said, I went into my solicitor the other day and I changed my will, because he knew that marriage nullifies all wills, which is, I suppose, an important thing to let our listeners know about. That if you write a will today and get married tomorrow, unless that will envisage the marriage the following day, it becomes null and void, and it has no legal standing beyond the date of marriage. So this guy knew about that, and he went in, he told his solicitor, look, now I'm going to leave everything to my new wife and she can leave it to my girls, because he had 3 girls from the previous marriage. And I won't use the vernacular I used when he told me this, but I basically said, you're an idiot. And he said, what do you mean? And I said, well, you've just now got assets that belonged to Dad to be inherited, because the new wife was much younger than him, so it was more than likely he was going to shuffle off first, that eventually his girls would be inheriting assets from a stranger and paying far more tax than they inherited it from Dad. And he put his hands on his head and he said, why did my solicitor not tell me? And I said, not their job. The problem here is that for the most part, a solicitor will do what you tell him to. You went in, my friend, you went in, told him, I want to leave everything to my new wife and on to my girls. He wrote it down. He got you to sign it. He got a witness in to sign it. And suddenly it was rule. And he's going, I call this the ripple effect. The problem here is that your financial person in this case does the thing you're telling them to do, but doesn't contemplate the ripples that creates, what else that does. Are you familiar with law practices, for example, that specialise in this field? Because it is a specialist field, isn't it?
It is, and there are law practices out there that do specialise in this and would be able to combine the legal requirements which the solicitor would have addressed in that instance, but also the tax requirements. There's dozens of different ways you can get that wrong. Take for somebody, for example, that has bought a property overseas. It's not unusual to be suggested to them as good planning that they do a local will for that property to administer it locally. So you have a property bought in Portugal, do a Portuguese will. Very good planning, well done. Then you think, now I'll go back to Ireland and I'll do my will for all the other assets. What's the first sentence that a solicitor puts on it? Unbeknownst, I make this as my last will and hereby revoke all former wills.
Which would be standard wording in the start of a will.
Correct. Which is now just revoked. The will.
The Portuguese will.
Correct. So there's quite a lot of care needed in getting it right, and it's very important to do so because, as you identified in your friend's case, the tax consequences can be enormous. And therefore, the financial assessment you made of the type of resources that your next of kin might need may not have allowed for the tax wedge, and therefore people are left short in relation to that. Yeah. I suppose, in risk of ending up swapping stories, the example I would have of estate planning like that was an individual whose spouse died, as you say. They were quite a wealthy individual that went off to live in Spain and were fortunate enough to find love late in life and got a new spouse. But the difficulty was they had planned and carefully did wills, so my assets go to my kids, your assets go to your kids, and all of that went very well. But then he died, and under Irish law, the spouse has legal entitlements, which she then chose to exercise.
This is the 1/3 legal entitlement for spouses, whether your will leaves it to them or not.
1/3 or more in certain circumstances.
Okay.
And with that, then you upset the balance and the expectation, if you like, of the survivors, all of whom were now in their 40s successfully settled and well catered for financially, but still had a succession expectation when the old man passed on, and that was significantly disrupted by it. And the individual I was speaking to wasn't one of the kids. He was married to one of the kids and had presented me with this issue. And I said, well, the one thing I can say is you're not one of the family here, so you need to stay out of this because it's not going to go well. And he said, yeah. I said, what is it? He said, he made me the executor of the will. So, he was right in the middle of it. I then said, my next sentence was, well, don't take on the job. He said, oh, yeah, just taking out the grant. So he jumped, he was in it. Said, you're going to have to explain to everybody and you're the one that's going to get shouted at. So,
yeah. Where there's a will, there's a row.
Potentially, but a lot of it is down to people haven't necessarily worked out the different considerations that might apply and what to deal with that. A lot can come up with family expectations. This isn't legal at all. When you're talking about the broader estate, what might happen at the family home? I had another instance where a friend of mine came to me and said, look, I'm married to a lady. Her parents are elderly. She wants to be able to look after them. The plan is It's a big house. We move into the family home. We build another house in the garden because it's big enough, and they'll live in that, and we'll inherit the house and we'll look after them during their lifetime. There's 2 more kids in the family, but they're separately married and well-to-do and will inherit other assets. And my advice to him was, that's an excellent plan. It solves a problem for the older generation. They have the comfort of knowing they'll be looked after by family members in their old age without feeling they're a burden on them because they've compensated for it. But I said, it has to be shared with the rest of the family now because it's a potential source of grief. And again, I said, and please bear in mind, you shouldn't be the one presenting this to the family.
Yeah.
It has to be your spouse because you're an outlaw. So he came back to me a week later and he says, God, he says, that was good advice. He said, I can't go near them for months because although they had their own homes and independently set up, the emotional attachment to the family home had to be factored in. And it was right to do it and allow people to adjust and think it through. But you couldn't assume that the logic of the situation would override the emotional attachment to the property.
Yeah.
But it had to be managed.
A friend of mine years ago told me we're emotional beings with the ability to rationalize, not rational beings with the ability to feel emotions. And where people go in terms, and of course, the death of a parent or a spouse is a hugely emotional time. Aidan, look, thank you again for today. What I would say to our listeners in terms of, I've said this before, but in terms of professional financial planning, there's really 2 aspects of professional financial planning deals with. The one aspect, which is your principal world, Aidan, is living too long. What happens if, like my dad said to me the other day, I expected to be dead 15 years ago. You know, the trustees of his pension scheme write out to him every year asking him, is he still alive? You know, because he is well beyond the norm. But so living too long. But the second issue we must deal with in planning is dying too soon. And we're very good in Ireland, as I said, or we're much better in Ireland at dealing with the living too long, but we're not great at dealing with the dying too soon. And by your details here today and by other things we've talked about in our videos and stuff, this is a hugely complex area, requires specialist advice, and the more money you have, the more likely there's going to be a row, because human beings are selfish. Human beings will act. You know, I said it to a consult the other day, you know, with 7-figure sums, it's, you use the word there, it'll be the outlaws that cause the problems, not your kids, but the people they're married to. Because the people they're married to don't care about your wishes, dad's wishes, you know, because dad's dead and he wasn't my dad. And they justify their actions by defending their own children. So it is a complex area. I will add one final thing. Making a will doesn't mean you'll drop dead. You know, I think that's one of the things people think. If I talk about dying, I'll die. Let me suggest to you out there, you don't have that kind of influence over the universe. So make your will, get proper advice, and the more assets you have, the more specialist that advice should be. Aidan, thanks again for your time today. Everyone listening, thanks for listening, and reach out through the descriptions below if you have any comments or questions to ask. Thanks a lot, Aidan.